Today is the 5th of August 2020. My name is David Hickson, and in today's market update I'm going to be speaking about the 20-week cycle trough, which would have been expected under normal circumstances to occur tomorrow. I'll explain what I mean by under normal circumstances in a moment. In the meantime, I must ask you to please make sure that you have read and understood these disclaimers. What do I mean by under normal circumstances? Well, in the 1970s, JM Hurst discovered his nominal model of the cycles that influenced the American stock markets. A nominal model is simply a list of cycles, and he had discovered that a particular combination of cycles with related wavelengths were influencing the price movements of the stock markets way back in the 1970s. The interesting thing is that that nominal model is still very applicable today, but because of the principle of variation, which tells us that the cycle wavelengths are constantly varying, we expect the cycles to be fairly dynamic. In other words, the cycle wavelengths will get longer and then get shorter over different periods of time. Now, the average length of the 20-week cycle, which was one of the cycles that he discovered, was 136 days. And you can see on this chart over here, which is of course of the S&P 500, that there have today been 135 bars or 135 days, because this is a daily chart, since the trough that formed on the 23rd of March over here, which according to this analysis, you can see at the foot of the chart, has been phased as an 18-month cycle trough. I discussed this in my previous market update video. And so at around about now, or in fact to be exact tomorrow, we would be expecting an average 20-week cycle to form a trough in the market. But what has happened? Well, the process of performing an analysis using a Hurst Cycles approach is one where you have to be constantly looking at the evidence of what is happening in the markets. I sometimes say you cannot simply set your alarm clock and go to the beach and then wait until a particular cycle is due to come in and then take a look at the markets and ask yourself why that cycle trough is not forming at the moment. And what has been happening in this market for some time now is it seems as if the cycles are running short. So I'm going to start by discussing the situation of the 20-week cycle on this chart. I have a much better analysis that I'm going to show you in a moment. So if you're not going to watch the whole video, then skip ahead until you see the next analysis, because that is, in my opinion, the much better analysis. So what is happening in this chart? Well, the software is working with the default nominal model. In other words, it's using the cycle lengths that Hurst discovered way back in the 1970s. The way in which a Hurst Cycles analysis works is that you don't always simply expect the average wavelength from 50 years ago to be applicable to today's market. And so the software works out during the analysis process what these cycles are likely to be doing at the moment in terms of their current wavelengths. And those current wavelengths are plotted down at the bottom right of the screen over here. So for instance, you can see that the 20-week cycle has recently been beating with a wavelength of about 16.3 weeks. In other words, it has been running fairly short. The 80-day cycle has recently been beating with a wavelength of 64 days. The average length of an 80-day cycle, you might know, is 68 days. And so the cycles have been found to be running slightly short. But an interesting thing is happening in this analysis. As the market bounced out of this 18-month cycle trough, we needed to start identifying the troughs of the shorter cycles. So obviously, in about June, we were looking for an 80-day cycle trough, and the software found such a trough over there. Now, if we measure the number of days from the 23rd of March until that 80-day cycle trough, we can see that there were, in fact, 84 days that elapsed from that March trough until the clear formation of what could be assumed to be an 80-day cycle trough. So why is that? I've just mentioned that an 80-day cycle averages 68 days in length. And in my previous market update video, I spoke about the fact that it seemed as if the cycles were running short. They were beating with shorter than usual wavelengths. Now, that is not totally unexpected. Because of the principle of variation, we know that these cycles are constantly varying in length, and that the shortening of the cycles is something that tends to happen throughout the nominal model. And so for the 18-month or potentially 54-month cycle trough that formed at the end of March, for that trough to have formed there, we would have had to assume that the cycles were running shorter. So why would the 80-day cycle suddenly run a lot longer? Well, that's not impossible. But you can see if we move this cursor to the 68-day point, there was no clear trough that formed at the 68-day mark. And so the 80-day cycle trough, which must have formed in the markets, would either have happened here earlier at 52 days, meaning the cycle was running shorter, or it must have happened later at the 84-day mark. Now, the software in this particular analysis is choosing the latter approach. In other words, it's positioned the 80-day cycle trough over here at 84 days. I would question that, and we're going to take a look in a moment at an analysis that takes the other approach with the earlier 80-day cycle trough. But one of the results of positioning that 80-day cycle trough in this position is that these nests of lows, now the nests of lows are formed by the alignment of the circles and whiskers. Now these circles and whiskers, you can see there's a circle, and the whiskers are simply the lines to each side of the circle and whiskers. They provide us information about when to expect the next trough of the particular cycle. Each of these cycles is color coded, and so you can see the 20-week cycle has this green color, and the circle for the 20-week cycle is telling us that the next expected trough for that 20-week cycle would have been over here, where I've just drawn that arrow above that circle. So that meant that the 20-week cycle trough was due about over there. The whiskers, or lines to either side of this circle, tell us the probable range of time within which that particular trough could occur. And we use the shortest cycle found in the analysis and the longest cycle found in the analysis to calculate the width, if you like, of those whiskers, and they present the full range of time in which the 20-week cycle could have occurred. Now you will notice from the analysis at the foot of this chart that there's definitely a disconnect in this analysis, and let me clear all these lines and just highlight that for you. Here we have a fairly neat nest of lows in terms of all the cycles from 80 days shorter, and then we have a clearly displaced 20-week cycle circle and whiskers over there. That's what I call a staggered nest of lows. Although there is only one cycle that is slightly staggered out of position. If we take a look at the next nest of lows for the 40-week cycle trough, you can see again the 20-week cycle has been fairly displaced from that nest of lows, which is actually centered round about here. What does that mean? It could simply mean that the cycles are busy adjusting and the wavelengths are adjusting themselves, but it might also mean that there is an error in this analysis and that we would do better to position this 80-day cycle trough in a different position. So let's now take a look at an analysis that does that. Here is that analysis, and you can see that there are a few differences. First of all, the 23rd of March trough is marked as a trough of the 54-month cycle. Now, I've been expecting a 54-month cycle to occur this year for some time now. In fact, if you look at market update videos from last year, November, I think I started speaking about the market coming down into a 54-month cycle trough. I was expecting that cycle trough to occur in June. And you can take a look at the series of market update videos that precede this one, and you'll see me speaking about that expected 54-month cycle trough. What has probably happened, almost certainly happened in my opinion, is that the 54-month cycle trough occurred early. What does it mean when a cycle trough occurs early? Well, it probably means that the cycles are running slightly shorter than we have been expecting. So this analysis is performed by means of applying a nominal model, in other words, a list of cycles that have slightly shorter wavelengths. In fact, we can take a quick look at them. Here is that nominal model with the list of cycles, and you can see that the 20-week cycle, for instance, which I'm still, let me change the color of that pen, the 20-week cycle, which I'm still calling the 20-week cycle, is in fact only 16.55 weeks long, as opposed to over 19 weeks long. And you can see that the 80-day cycle is 58 days instead of 68 days, so it's a slightly shorter nominal model. The results of applying this nominal model, as you can see, are that Sentient Trader has positioned the 80-day cycle trough over here in the middle of May at that position. So that's now our 80-day cycle trough. The 20-week cycle trough it has positioned over here in the second week of July. And if we go and have a look, that's actually in that position over there. Now you might remember from a moment ago that that was pretty much exactly where the circle was for the 20-week cycle. In other words, that was when we were expecting the 20-week cycle trough to occur. Now looking at this analysis, the position of that 20-week cycle trough over here looks slightly awkward. I've spoken in market update videos before about the formation of triangles in the market and how the position of a cycle trough is very often the final sort of touch of the trend line in the formation of the triangle. And so in my opinion, it's much more likely that the 20-week cycle trough actually occurred over here. So I can tell Sentient Trader that's where I want to position my 20-week cycle trough, and I've done that. Let's take a look at that analysis. Here is that analysis. You can see that I have influenced the analysis by doing what's called pinning a trough. I've pinned that 20-week cycle trough below this low over here. Now this analysis, in my opinion, is a really good one, and this is the analysis that I'm focusing on at the moment. Although I do continue to keep an eye on the other analyses, I think that's very important. Very often I find that charts tend to go back to their original default analyses. At the end of the day, the default analysis often seems to win the day, but at the moment this analysis is looking very good to me. First of all, we have our 54-month cycle trough, which, as I've mentioned, we've been expecting for some time. Then the 80-day cycle trough over here is in a very sensible position in terms of the price formation. And the 20-week cycle trough is nicely positioned at the end of this triangular or wedge-shaped formation, which is, in my opinion, a very good position for that 20-week cycle trough. And so there's been some discussion on Twitter and on the forum and various platforms about this 20-week cycle trough, and many analysts and traders have suggested that price is still coming into that 20-week cycle trough. In my opinion, as you can see, I think it is likely that the 20-week cycle trough has already occurred and that it occurred early. At the end of June, or perhaps that's the end of June. I think that cycle trough occurred. Now, the other thing to point out about this analysis, and one of the reasons why I particularly like it, is that these nests of lows are so very, very neat. That is not always an indication of a good analysis, but a neater stack of those circles and whiskers, neater nests of lows, tend to indicate more regularity in the cycles and probably a better analysis, assuming that those troughs are indeed well positioned. You can get very neat nests of lows, but the positioning of the troughs that you see in the analysis are absolute nonsense, in which case clearly that's not a good analysis. But in my opinion, this is a good analysis. You will notice, however, that we do have, again, a staggered nest of lows with this 40-week cycle trough. The circle is only expected here. Now, what does that mean? Well, because the 40-week cycle is being measured over periods preceding the previous 40-week cycle trough, which was on the 23rd of March over here. That means that the software is, of course, using information from before March of this year. Now, if the 54-month cycle trough did form a trough in March, then all of those cycles are going to get a big boost of energy because of the fact that they've just bouncing out of a 54-month cycle trough, and using information from prior to that time to project to the next cycle trough might seem a little outdated. I've had some interesting discussions about this concept with some Hurst analysts, but there isn't really a better approach to doing it. You could try to anticipate the fact that cycles will compress following the formation of a really big trough, but trying to anticipate changes in cycle wavelengths is a fairly dangerous thing to do, and so I prefer to look at the chart, understand what's happening, and then make my trading decisions on the basis of that. So, in my opinion, this is what has happened. So what does that mean we should expect? Well, let's take a look at the composite model line, which I've spoken about before. The composite model line, you should know, is the result of taking all of the analysis information contained in the analysis at the foot of the chart in terms of the cycle wavelengths and their amplitudes, recomposing that information and showing you in the past what would have happened if the only thing moving this price were those cycles, and it then projects that information into the future by assuming that the cycles will keep beating with the same rhythm, which is a fairly flawed concept, but it provides us with some understanding of what the analysis implies is going to happen. And so here you can see this 80-day cycle trough over here is in fact not expected to be a very big event, because the amplitude of the 80-day cycle has clearly been calculated to be very low. The next big-ish event is the drop into this 40-week cycle trough, which according to this analysis is expected in about the 3rd week of October. So we're going to be looking for a bit of a move down into the middle of August for this 80-day cycle trough over here. But then we're probably going to see an even higher peak in early September, and then a move down into the 40-week cycle trough in the 3rd week of October. Let's go back to the default analysis and just compare the composite model line on that analysis. As I've mentioned, I do think it's very useful to keep an eye on the default analysis at all times, so I will display the same composite model line over here. You can see the difference here is that the composite model line is telling us to expect price to be moving down at the moment, because of course this analysis is still expecting the 20-week cycle trough to form in the markets. It was expecting the peak to have occurred in early July and the market to have moved down towards the 20-week cycle trough. The market clearly did not do that. It has been moving counter to that composite model line, which is a bit of a warning that in fact there's something not right about this analysis. Nevertheless, the next bigger trough, well, let's speak about the peak first of all. I mentioned the other analysis was telling us to expect a peak in early September, and this analysis tells us to expect a peak in about the 3rd week of September, so not very much difference. We are looking at a peak forming in September, and then we are looking at the next 40-week cycle trough over here. In this analysis, it is expected to occur a little bit later, end of December or early December. So that is what lies ahead of us. I'd be very interested to hear what you think has happened to the 20-week cycle trough. Has it formed? Are we still expecting price to move down into it? I do hope that you found this market update interesting. If you have any questions, please post them in the comments below the videos or send us an email. I always look forward to hearing from you, and I wish you, as always, profitable trading.